Duration is one of the most familiar concepts in fixed income, yet it's also one of the most misunderstood. Most people treat duration as a simple measure of price sensitivity to interest rate changes. While that's true in stable environment, it breaks down in volatile macro regimes where interest rate moves are nonlinear, yield curves twist rather than shift, and hedging flows amplify dynamics. This is where convexity, the curvature of the price-yield relationship, becomes equally important. Together, duration and convexity determine how a bond or portfolio behaves under real-world stress. Start with duration. The basic idea is straightforward. If a bond has a duration of 5 years, a 1% rise in yields should lead to a 5% price drop. But that's a linear approximation. In volatile markets, rates don't move in straight lines and portfolios rarely hold static exposures. So the real-world impact of rate changes can deviate significantly from duration's predictions. This is why convexity matters. Convexity measures how the duration of a bond changes as yields move. High convexity bonds, like long-dated zero-coupon treasuries, lose less value when rates rise and gain more when rates fall. In other words, convexity is beneficial in most rate environments. Low convexity or negative convexity instruments behave differently. Mortgage-backed securities are the textbook example. When rates fall, homeowners refinance, shortening the MBS expected maturity, reducing duration just when investors want it most. When rates rise, refinancing collapses and the maturity extends, increasing duration at the worst possible moment. This extension risk is one of the reasons MBS hedging can create powerful yield curve moves, especially around the 10-year point. For portfolio managers, understanding convexity is essential when interpreting market volatility. Two portfolios with identical duration may behave very differently if one has far more convexity. Long duration, high convexity portfolios are more stable across large rate moves. Low convexity portfolios may see sharper losses and require more frequent rebalancing. Corporate finance teams face similar dynamics. When a treasurer chooses between issuing short-term floating-rate debt or long-term fixed-rate bonds, they're implicitly choosing a duration profile. Adding swaps, collars, or cross-currency hedges further alters the convexity of the liability structure. A funding strategy built only around duration will miss the second-order effects that matter most when rate volatility spikes. Inflation regimes also affect duration and convexity. In high volatile environments, central banks respond aggressively, and yield curves can steepen or invert rapidly. This means portfolios with complex convexity profiles, such as those holding MBS, callable bonds, or long-dated corporates, need more frequent risk assessment. Even ETFs can show convexity-driven deviations from net asset values during stress, especially in thinly traded sectors like long-duration credit. Duration and convexity aren't just academic concepts. They explain why some portfolios hold up under volatility whilst others crack. They determine the real sensitivity of corporate funding costs, and they shape how markets behave during sharp repricings. In today's environment of rapid rate changes and uncertain policy path, mastering duration and convexity is essential for anyone managing interest rate risk.